Hello and welcome to this very special episode as we approach the year end, calendar year 15. It's not just important to try and predict or try and guess what will happen in 2016, but also look back and think of the key things that you need to monitor or key things that you need to make note of, what market has taught us in order to become better investors. And two men who are really good investors need no introduction. Morgan Stanley Investment Management, Swanand Kelkar, Amay Hattangadi join me on the show. Thank you so much, gentlemen, for joining in.
Thank you.
Interesting title, Amay. Simavalokana, right?
Mm-hmm.
Am I getting it correct?
Yes.
It means look back as well and
That's
try
right.
and take lessons.
That's right.
The key lesson that 2015 has taught you.
That's right. So Simavalokana is a Sanskrit phrase which says that as the lion walks in the jungle, he looks back after every few steps to pause and reflect and to see the course that has been traversed, and that's what Simavalokana means. And I think in our day-to-day jobs, we are so immersed in looking at markets, trying to make predictions in the future, that it's very important to periodically pause and look back at what's happened in the market so far. And what are the lessons that one should draw from what the markets have taught us?
Yeah, so Swanand, what stood out? I mean, there are a lot of points, but if you had to summarize it succinctly, that one large thing that really stood out for you if you look back at 2015?
The one thing which stood out is in India, we have four broad asset classes as investors that we can put money into. If you think about it as equity, fixed deposits, property, and gold. And if somebody asked you at the beginning of 2015, of these four asset classes, which would be the best performing one, I think nobody would have said fixed deposits. And that's what's happened in 2015, that amongst all these four asset classes, the best returns have come from fixed deposit at 8.5%. So the key lesson is don't get swayed by the flavor of the time or the flavor of the moment. Have a disciplined asset allocation strategy if you are looking to build wealth over time.
An interesting note that has been made is to have a disciplined asset allocation for retail investors, maintain a balance between equities and fixed returns as well. By the way, just before we get to the other lessons, Swanand, since we are talking about the flavor of the season, I think what's also the flavor of the season is how some of the new age companies or the new listings have done too. I mean, we've seen a bunch of IPOs doing very, very well. We'll get back to the learnings for the year.
Sure.
But is that an indication of flavor returning in a manner of speaking to the equity markets as well? Because we've seen domestic funds keep on getting in money. And this is one more way wherein retail investors are participating in the equity markets via the new IPOs.
Sure. So it would be difficult to extrapolate the IPO trend into the broad markets. And the reason being, we haven't seen mega-sized IPOs, right? All the IPOs that you're talking about are more in the $100 to $200 million kind of a range.
Say for maybe an Indigo.
Except maybe an Indigo,
Yeah.
absolutely. So for good quality names, there is definitely appetite. For every couple of IPOs which have done well, I'm sure there are 2, 3, 4 more which haven't done so well. I wouldn't say that equity appetite is roaring back just because IPOs are getting oversubscribed, etc. And as you said, one of the factors which is driving this is that the domestic mutual funds, the domestic institutions have got money and they're subscribing to these IPOs. So difficult at the moment to draw a broad equity market trend just from the IPO subscriptions.
One more lesson, and I think this will probably hold true for the year ahead as well. Think stocks, not sectors. It's never been probably more true than in the year gone by, wherein within sectors as well, there has been divergent performances. You take any one. And is that the key lesson? For the markets at large, I think that would be the key lesson, Amay. I mean, because everybody who's been very, very stock specific and bottoms up has probably done well, even though it's been a bad year for equities.
That's right. I think typically what happens is when we start off thinking about equity investing, unfortunately, people look for themes or people try to make some mega predictions or which sectors will work.
Right.
And the trend over the last year or two really has been that there is no single sector or group of sectors which have consistently done well or some group of sectors which have consistently done badly. You could make some exception for sectors such as global commodities, which have seen significant corrections. But barring that, within most other sectors in India, it's been a pretty, the performance has been in a pretty tight range. In fact, we looked at the numbers for the last 10 years or so, and the standard deviation of returns among sectors has probably been the tightest in 2015, which basically means that if you just put all your bets in one sector where you went overweight and underweight some of the other sectors, that was not really the way to play the market. A top-down sector view was not what help you generate good performance. What was important was to be able to do your bottom-up analysis and to pick the right stocks within each sector. So it was not one broad theme, one broad sector that worked.
And do you think the trend could continue for 2016 as well, wherein it will largely be bottom-up as opposed to, say, a large theme performing irrespective of what the company in the sector does?
Well, unlike 99 to 2000, unlike 2003 to 2007, at this point of time, we are not really seeing a single mega theme.
You're not.
We are not yet seeing a single big theme out there, which will trump all other sectors, and that's the only sector that will work. So we're not yet seeing that, and hence, as things stand today, if I were to look into or try to make a prediction for 2016, I would say it could probably be more of the same, where there is no single sector which is handsomely outperforming the others, but you have to look more granular, and there are certain stocks within each sector which do well.
I just want to pick your brains on one key point as well, which is again a lesson that good macro does not equal to good markets. I know we briefly touched upon it, but what happens over the next 12 to 24 odd months? Certainly the macro repair seems to be underway, and while that was the case in 2015, the equity markets did not perform. Do you think that could change, wherein there could be a macro repair and yet there could be a good equity market performance too in the next 12 to 24 months?
Sure. So the point that we are making is trying to find a correlation between market performance and the macro fundamentals over a short time period, which I mean 12 months, can sometimes be tricky. And the example that we give is of 2012, a year in which probably every macro fundamental pointed in the wrong direction.
Right.
Both deficits ballooned, growth was lower, inflation was higher, and markets returned 30%. Cut to 2015, and every macro fundamental has pointed probably in the right direction. Inflation is lower, rates are lower, GDP growth likely to be accelerating next year, deficits are better, and the market is down 7-8%. So macro is just one factor which goes into equity market returns. It's not the only factor. There is starting point valuation, corporate fundamentals, things like that. And the other thing which a lot of people kind of forget is almost 40 to 45% of the earnings for, let's say, a BSE 100 are outward looking. They are from sectors which are export oriented, they are sectors which have linkages to global commodities, pretty much have nothing to do with the India macro.
Right.
So there are these companies, mega caps, large ones, which happen to be listed in India, but have nothing much to do about the Indian macro. So making that correlation on a short-term time frame, we spend a lot of time thinking about the macro. Making that correlation between the macro fundamentals and the equity markets is slightly difficult. To the question that you asked, does the macro repair is evident. I think there is no debate about that. And over the last 12 months, we have come a certain way.
But you're saying that even if that happens, that will not necessarily mean a good year for equity markets. It's a necessary consideration.
That is not a sufficient consideration.
Right.
That is not a sufficient criteria for equity markets to do well. There are many other things. So 2012, which I talked about, 2011 was a horrible year in terms of returns.
Yes.
So what worked in 2012 was just starting point, more than anything else, that your valuations were so depressed that you did well from a low base. 2015 was exactly the reverse. 2014 was up 30-35% in terms of the Nifty returns. And from that starting point, you had a fairly muted year. So trying to find that correlation on a 12-month time period can be quite tricky.
And can be quite fatal as well. But would the point number 7 and the lesson, Amay, that effects of being in a bad neighborhood have something to do with this? That there was a macro repair underway, but because India is in a bad neighborhood, irrespective of how good the macro would have looked, we still would have underperformed.
Yeah, I think, let me just define the neighborhood for the viewers. What we mean by neighborhood here is that no matter what, India is a part of the emerging markets basket or a part of the Asian basket. So while the common refrain we hear from time to time is that the India macro still looks much better relative to other emerging markets or to other Asian economies. And hence India should continue to do well. This is a common refrain we hear. I think what we should not forget is that when it comes to flows particularly, you have emerging market funds which may face redemption pressures, you may have emerging market ETFs selling down, and then they sell pro rata across their markets, right? So the fact that India is a part of this asset class, emerging markets asset class, it cannot stand out in isolation. So it's important when we look at the fundamentals of India, we also, consider the fact that it's part of this larger basket. And if the overall basket is not doing well, there may be some relative outperformance, but that itself cannot necessarily mean handsome returns.
For the equity markets to do well, oil needs to move up. I think that's another common refrain that I've now started hearing. But the one interesting one, before I get to themes for the next year, because I think that's something that viewers would want to know, and the interesting one, Swanand, is that you are arguing for evidence. I mean, of course, it's done that. Evidence has triumphed over hope. But typically, markets tend to discount what is going to come.
Sure.
This time around, you're saying that the lesson learned is that let it come into print.
Absolutely.
You think that will hold as well?
That's true. So the environment that we are in, the regime that we are in, is a growth scarce environment.
Yes.
It's not as if growth is plentiful and many sectors and subsectors are doing really well. It is easy to weave a story around a lot of sectors, right? And especially when these stories are based on per capita consumption, etc. So when you have 1.3 billion people in the denominator, per capita of everything looks very low. And you can always say that this is going to go up and let's then buy these stocks and these sectors. Our simple submission has been wait for evidence, wait for a turn in operating parameters for the stocks that you are looking for. Even if you end up not catching the absolute bottom, but buying those stocks maybe 15, 20, 30% higher than the absolute bottom, you are ensuring that you avoid duds in your portfolio. By ensuring that you haven't gotten into a story which was just a story and never played out, and the stocks remain dud. So you'll have enough time. Growth is scarce. If you pick up the inflection point not exactly at the bottom, but even 10, 20, 30% later, there'll be enough money which will follow you if that trend remains sustained over a long period of time. Case in point was commercial vehicles. It has been a bright spot in terms of growth for the past 12 to 18 months. We have some positions in that space.
Yes, you do.
And we did not buy it at the absolute bottom. We bought it probably 10, 15, 20% higher than the absolute bottom. But as the trend got reinforced, enough money piled into it for us to make good returns. So hear the stories, but be skeptical.
Let's try and talk about some themes, which is on your focus list. Whether it does well or no, it's a separate thing altogether. And correct me if I'm wrong, but if I look at the kind of holdings that you have in your schemes, you guys are bullish, if not overweight, on IT. Am I wrong?
No, I think, like I said, so without speaking specifically about the portfolio positioning, I think in an environment where the local macro was challenging, as Swanand mentioned, that you still have companies which are outward looking, where a large proportion of the earnings come from outside India. IT and pharma have been the popular bets, which have worked well over the last couple of years or so.
Yeah.
So I think, you're right. Looking back, that has been the trend.
But there's a bit of a hiccup that is coming for IT.
That's right.
Or for pharma.
Yeah.
What do you think is the...
No, so I think the pressures that we are seeing even in the developed world in terms of growth are translating into the IT sector as well. So you're seeing that in terms of the one is now we are talking from a much higher base. The size has grown for the large players.
Yes.
And you will there are a lot of technological changes happening across the world, and you have to see how that plays out for the Indian companies.
I'll come to you because you mentioned about CV and the uptick that we saw. You are positioned there, but the stocks are no longer at the levels that they were in. Do you think the theme could continue?
My view on that is within what is labeled as industrials, and industrials is a very hold-all term. It has many type of companies inside it. Our template of investing has been simple. Look for growth inflections, convince yourself that they are sustainable, and find quality companies within that space. It's as simple as that. And that's how we zeroed in on commercial vehicles. That's how we then zeroed in on passenger vehicles, etc. Have things become overvalued? Difficult one to answer. It is not as compelling as it was, let's say, a year ago when the trend was just taking shape.
Yeah.
But has the trend run out? I would say no. I would say commercial vehicle, that space would still continue to do well in terms of the operating numbers. The bigger question is the operating numbers versus valuations. The best part of the returns, I think, are behind us. But I don't think that the story is done yet from an operating standpoint.
Okay. Amay, I'm not asking you to name specific stocks. Obviously, I won't do that. But if I look at your positions in financials, you have things of the highest quality, the HDFC banks of the world. You also have some slightly indifferent themes, the rating companies, so on and so forth. What are your thoughts? Because if there was one space that everybody was bullish on, consensus at the start of 2015 was financials, and nobody expected it, but they really haven't performed for 2015. Do you think that could change in 2016? And if so, where do you think the high beta could come in? Would it be still quality, or could it actually move on to the second-run quality names in the private space? Or would you go far out and say that even the PSUs could make a comeback?
So one, of course, the overall credit growth has been extremely anemic at 9% or so. But I think that's the headline number. What one needs to do is to try and look in a more granular fashion to see where is the growth, what are the growth pockets within the financial services sector. And one of the trends or one of the themes that we constantly talk about is the financialization of savings. What we have seen in the last few years is that consumer lending has been much more resilient. And most of the problems that you see in the financial sector have been on the corporate book, particularly in project finance. So what's important in the financial sector is to boil down, to look at the individual companies and see how is their what is their book made up of. So in India, you do have a lot of interesting NBFCs, which may be in microfinance, which could be large brokerages now diversifying their revenue streams. You have NBFCs and banks which are focused more on the consumer lending segment. So you do have these stocks in these segments which continue to see much better growth than the headline 9% number, which have much better asset quality. And I think you need to segregate that when you look at the financial sector. And we do see interesting themes within the financial sector, and we continue to see that. I think there is too much obsession about the SOE banks and when will the NPA issue get resolved. And time and again, investors have tried to play the mean reversion trade for several times in the last 15 years, and there have been false starts there. But I think it's very difficult to try and predict when that inflection point would come. But in that process, don't forget the fact that there is so much else happening in the financial sector, which is so interesting, and where the growth has been much better.
I know you guys started off the discussion saying that it's difficult to have themes, but since I can't talk stocks with you, what is that big emerging theme, trend that could be visible? You may have an idea in that theme and not necessarily the whole theme, but what are those pockets?
So as Amay mentioned, the one theme which we think has become very interesting is financialization of savings. People putting money more into financial assets than gold and property. So there's always this game which is played, right? I mean, who's going to be the Amazon of India? It's probably going to be Amazon itself. Who's going to be the Google of India? It's probably going to be the Google itself. But we feel over the next 3 to 5 years, and I hope this becomes evident, that the JP Morgan of India is going to be an Indian player. It is not going to be one of the foreign guys. JP Morgan of India is not going to be JP Morgan. So we feel that if we find this good financial services provider who plays into this theme of financialization of savings, I think that's a good theme, long-term theme to play. And this could manifest itself to several things, through asset management, through wealth, capital markets, things like that. So that space looks interesting to us.
It does, right? The operating leverage is fairly high.
The operating leverage is fairly high. Competitive intensity has actually come down because a lot of the foreign houses have taken a back seat in some of those spaces. So that space looks very interesting. The regulatory thrust is for more financialization, and making people go away from physical savings. So the environment is very conducive for this to happen. It's just about who goes along what route and capitalizes the opportunity. But we feel that in the next 3 to 5 years, you will see a large financial services company emerge out of India.
Okay. Read between the lines. And Amay, just wondering, before we get in final thoughts, I mean, is your personal top favorite the same as what Swanand says, or is there something else that is also top of the charts in terms of emerging themes?
So although I made the caveat earlier that you should not just look at big themes.
Yeah, I know, but since I can't talk.
But the point I do want to mention is, you have to now look at, clean energy is definitely an emerging theme. And you have to now try and figure out how best to play that theme, whether you'll have more gas-powered plants versus coal-powered plants, whether you're going to have more solar-based projects. So that's one theme that needs, and the surrounding infrastructure around it, gas pipelines. So there's a lot that one needs to look into, right? So So we are seeing increasingly, right, including we are seeing the pollution levels in cities have gone up so much. So again, thrust towards CNG. So clearly that is, I think, is going to be an enduring theme. And we do need to look into that theme closely.
And which also comes back to your earlier point on financials, right? In India, a lot of these sectors are played through the financiers of that space.
Yes.
Be it commercial vehicles, be it the microfinance, or be it even renewable energy. So although the stocks that you own appear under the financials label, they're actually plays on the theme, which is so they're lenders to that space.
Yes.
And that's something unique about India, that you have these specialized lenders into certain sectors. So you might feel that you have a lot of financials, but there actually plays on that sector, which is derivative of that financial company.
Great. Okay. So final thoughts really before we wrap up this interview. Since it's actually looking back in 2016, Amay, it's a very interesting note that you guys have written. Your key takeaway or your favorite part of this?
Well, they're all my favorites.
You can't have the whole report as a favorite. But one thing that really stood out, you thought that this is something that you should mention.
I like some of the behavioral finance points that we always make. And I think one of the points that we often say is that don't get carried away by the narrative fallacy, right? So at this point of time, you will see so many reports telling you why oil should probably go to $20, and they'll justify it by saying what's happening to demand, how there is enough supply.
Sure.
And so that's the narrative today. But if the oil prices were going up, people would have found enough reasons to justify that. Tensions in Syria, problems in the Middle East, cartelizations. So we often get caught too much into trying to explain events, and trying to build a reasoning around those events.
Sure.
And I think 2015 was no different. Whether it was the much hyped Fed liftoff event that we focused on for so long, or you had people, having different narratives on what the current government is doing in terms of economic reforms, you had people trying to justify why commodity prices will remain lower for longer. So I think the point really for me is that we get too much caught up with specific events, and I think that's something that we should look through. Elections being one of them, we get so caught up in what the election outcome is going to be and what will that mean for markets. Again, one event passes, the next one comes, and I think that's something we need to. Thankfully the next year is not so heavy in terms of legislative. But quick 30-second response from you, Swanand. Anything that really stood out for you?
So I think the point that I made earlier, and it flies a bit in the face of conventional investing wisdom, is that wait for evidence. This is a growth scarce environment. Wait for evidence. If you convince yourself that you have found an enduring growth story, pile onto it. That makes investing so much easier because you have discarded probably 9 out of the 10 stories and focused on the one evidence-based theme that is out there.
Great, gentlemen. Thank you so much for joining in today. It was a very interesting discussion, some key lessons learned, and I'm sure our viewers benefited as well. Always good having you. Look forward to having you more often on the forum.
Thank you.
Well, that was the Morgan Stanley Investment Management View on the key lessons learned from 2015 and how to apply them best for a fruitful 2016. Thanks so much for watching.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.